Good afternoon, everyone. Thank you for joining our webinar here representing the top 3 hidden gem stocks. We had a lot of great feedback from last week's hidden gem, so I thought I would triple up and give you guys 3 hidden gem stocks to talk about starting off with January. My name is Marcos. Apologies if I sound a little bit under the weather. That's Sydney weather for you. I'm joined. I hopefully will be joined today by my special guest Cameron, depending how busy he is. But just on to the next slide here. First thing going forward, just a bit of housekeeping, of course, as always. The content in this webinar is, of course, general advice only. If you require any personal financial advice, please seek your registered financial planner or broker. So just with the hidden gem agenda for today, I'll do a quick recap of what's been happening so far. A lot of macroeconomic news coming out of the US specifically that I'll touch on briefly, and of course our hidden gem stocks, which I think is why everyone is here for. So just here you'll see on the slide. Yep, where the equity market is headed. So over the last couple of weeks, of course, the ASX 200, it was relatively flat yesterday, added just about 7 points, but we're sitting close at, 7,400 resistance level, which is pretty crazy. It's made back almost, well, it's actually increased more in the last couple of weeks since the start of this year and has outperformed basically taken back all the losses that we've incurred over the last over 2022. So now market participants are really looking to, taking a look at a few clues as to how they're going to trade this position. You can see obviously the trend line is quite good. A lot of Fibonacci retracements may be possible. As I said, that 7,400 is a key resistance level. If we're able to break through that, we could be seeing all-time highs coming back again. But we'll be trading in a pretty tight range. Bond yields are starting to fall. We'll touch on as to why a little bit later. And of course, the Australian dollar is holding pretty high. We're sitting about that 69 US cents, which is pretty good for our international consumers. But you can see here on the next slide. So, excuse me. So our mate Jerome Powell, everyone wants to know what he's going to do. So the CPI figures were released previously on the 12th of January, slightly softening at about 7.1%. So we've officially gone over that peak. They had that initial headline inflation sitting about 8.5% previously late last year, and now we're starting to come back down, particularly with strong September US non-farm payrolls, basically outside of the non-farmer employees, because farming is of course slightly cyclical. We're still reinforcing quite strong unemployment, strong employment and very low unemployment over in the US and domestically as well. So we're pretty confident, of course, that the market will be looking for additional rate hikes going into the next couple of months. But we'll start specifically focusing on the US December retail sales that actually came out overnight last night. So I did a bit of a brief wrap up here for you guys. So the US market opened on Wednesday after a bigger than expected drop in December retail sales. So this is really supporting hopes of smaller rate hikes coming out of the US Fed. You can see there the October consensus, and then going forward to 2023, January 18, the consensus was the expectation was a 0.8% drop in retail sales. We saw a 1.1% drop in December. And that's pretty telling. Of course, you have your Cyber Mondays, your Black Friday sales, and of course Christmas. But retail sales obviously still dropping. Disposable income is obviously quite a concern now that a lot of consumers are obviously having to focus on servicing things like their mortgages, and of course the cost of living increases don't help either. So that rose less than expected year on year in December, and we're seeing a bit of a moderation in inflation, i.e. a reduction in increases in prices, which is good to see. So now the market, based on the futures markets and of course the 10 and 2-year bond yields, market participants now expect a 25 basis point hike where it was previously expected for a 50 basis point hike in February. And the terminal rate, we're expecting that to reach about 4.88, close to about 5% by June, which will be very, very interesting. So of course, before I get into our hidden gem stocks, I just wanted to reiterate, of course, exclusively just for our webinar viewers here, you've got some pretty great discounts on the membership here. You know, a lot of people do, it's really dependent, of course, as to what you're after in the service. A lot of people do sometimes tend to go for the gold, which basically just gives you access to all our research portfolios, and of course a dedicated account manager, one of our great team members here, who'll be able to help you out. But primarily what you're looking for to get the best value out of the membership is that diamond membership, where of course you get access to the full suite of portfolios. You get a few accesses to the technical analysis software tools, which are really useful for charting and of course screening the market. And of course you've got the reviews with our leading analysts, which you know, trying to be humble there, but of course that includes myself and a few other of my analysts here, basically where we rebalance your portfolio and see how we're going to navigate through 2023, which a lot of clients have been really asking about because it's going to be quite a crazy year. So I'll focus, of course, now onto the most important part, the stocks. Deterra Royalties, I believe I mentioned this one last week with regards to our income. But I think it's probably one of the most stable and useful stocks to hold, especially, as I said, in an increasingly volatile time. So you can see here on the chart, you know, it's a super streamlined business. Their operational costs are pretty much negligible. There's about 5 employees total in the entire business. And the company simply receives an ongoing royalty payment of approximately 1.2%, which is managed and primarily owned by BHP. And that's South Flank expansion coming out of the Mining Area C. It's basically the world's largest iron ore hub there in Western Australia, of course. And it's got one of the lowest cost and lowest carbon emitting iron ore in the world, especially compared to your other big players, Fortescue, who have that sort of lower grade and of course higher cost increases. So of course having that managed by BHP, having an ongoing royalty payment with a primary iron ore mine life, I think about 20 plus years. So your BHP is not going to go out of business anytime soon. So you're got, based on the current share price, the dividend is sitting at about just above 7.1%. However, we are expecting the iron ore current production in that Mining Area C to actually double over the next couple of years. So we of course expected an increase in those royalty payments and of course a flow-on effect back to shareholders. So you'll see here in the next slide the highlights for financial year 22. You know, really useful. Just getting $265 million in revenue, pretty much just to chill. And I've had to mention there, of course, with that massive EBITDA margin of 97%. Basically, what that means is the operational costs to run the business was approximately $8 million, which is pretty amazing. So prioritizing those shareholder returns in the form of dividends. The last 2 dividend payments were sitting about 22 cents and full year dividend of 33.76 cents per share, fully franked. And of course, 100% payout ratio, which is always good to see. Your primary, especially when it comes to your miners, you know, you usually look between about 30 to 50% of profit is paid out to shareholders. Deterra doesn't have that problem. So we've got that target price of about $5.10. That's another 10 to 15% in capital growth, not including, as I mentioned, the increase in iron ore production going into the next couple of years, which would be quite useful. All right, that one obviously is pretty self-explanatory, but one that we're taking a look at now is Beach Energy, obviously in the oil and gas space, primarily in South Australia there. And you'll see on the next slide, so there has been quite an intense volatility period in the past few months. They were sitting close to that $1.80 mark resistance level. That's since dropped back down to about $1.50, $1.55, I should say. That was primarily due to the failed takeover of Warrego Energy. They were outbid by Gina Rinehart's energy company. You know, pretty hard to compete with the richest woman in Australia. But in saying that, the company remains a strong buy currently on the current share price. They boast about $1.2 billion in free cash, which was primarily going to be used for that Warrego Energy buyout. But they didn't want to overpay, of course, so they'll be looking to deploy that cash for looking for further M&A opportunities, mergers and acquisitions, and we're really excited for what they're going to do this year. And you can see here, still quite a lot of strength in the crude oil price. Brent crude sitting about 84 and 70 cents per barrel, but the oil futures has fallen slightly lower in January to about 75.94 US. So look, there has been a bit of immutability with regards to the trading in the futures market. Not a lot of major demand pulls that we saw, of course, in February after the Ukraine-Russia initiation in the war, I guess I should say. But yeah, on the positive side, the US Biden administration has confirmed that they'll be buying 3 million barrels of crude per day for the month of February in order to replenish the United States Strategic Reserve numbers, which is great. So long term, as I mentioned, they were expecting quite a lot of strength in the oil price despite the recent pullback. And Western European energy and petroleum demand is also expected to carry forward into 2023 as well, which is quite useful. But stock number 3, this is probably one of my well, not my favorite stock in the world, but it is probably one of the most interesting stocks on the ASX. Mineral Resources. If you're a fan of the West Coast Eagles, that's how their office looks. It's pretty fancy, but they're on the West Coast. You'll see here, it's probably one of the most highly diversified business models, especially on the ASX. Number one, of course, they have a top 5 global, they are within the top 5 of the global lithium producers, and they're also vertically integrated. So they're not just producing that primary spodumene and shipping it off. They also have a hydroxide plant, which, taking into consideration the amount of margin that we're sitting on, the hydroxide price peaked late last year, about that 80,000 US. I think it's currently sitting about 75,000. So it has dropped off a little bit, but in terms of the margins that they're able to produce for that, pretty intense. And of course, on top of that, they're also a top 5 iron ore producer. They're currently sitting about 35 million tons per annum with a production cost of $40 FOB, which is free on board. So with the iron ore price currently sitting about that 120, I believe, still quite a bit of profitability to be made. On top of that, they are the largest contract mining services company in the world. They provide, mining rigs, mining equipment, and of course contracting services to quite a lot of large miners, including Rio, a few coal miners as well. And on top of that, they're the largest landholder in the Perth Gas Basin, which has gotten quite a lot of especially recent media attention as well. You've got the guys like Strike Energy, which is also one of the great recommendations that we've put in our mining portfolio as well, which is sitting about 68% return for the last 12 months. Strike is interested in taking up a position in Warrego Energy as well. Warrego Mining. Norwest Energy, however, is the one that Mineral Resources is looking forward to purchase, and they have a current all-scrip offer currently being reviewed by shareholders, which is really useful as well. So taking a look at the quick price chart, they have, of course, 100 in the last 24 months already. 140% capital return. So you'd ask me, okay, well, what's the potential upside going further? We do still expect a target price upwards of about $100, so still representing at least about a 10-15% return in the next sort of 6 to 9 months, depending as well potential further upside via that strong merger and acquisition business model that they've utilized. They've got some really great management skills in the team. They have quite a strong track record of mergers and acquisitions. They've actually, based on the most recent takeovers that they've produced, those shareholders who participated in said takeover have actually returned over 25% every time that's occurred, which is pretty good. And of course, a dividend growth of 20% per annum since their listing in 2006, so 16 years ago. Currently have about a fully franked dividend yield of about 3.1%. We are expecting the dividend per share forecast to hit about that 4.5% going into next year. And since its listing as well in 2006, it's actually delivered the second highest total shareholder return of any stock on the ASX 200. So a lot of potential further growth catalysts for Mineral Resources there, and it's probably one of the ones that doesn't really get a lot of attention, especially in the lithium space. Not sure why, as I said, because it is still top 5. But you know, a lot of focus does primarily get shifted to your big boys like Pilbara and your core lithiums and your AVZs, etc. But mineral resources, of course, is definitely not one to count out, especially having that iron ore exposure as well. So I thought that one was really useful. Hopefully you found that useful as well. Any questions? Of course, feel free to give us an email admin@stockspecialist.com.au, or you can give me a call on my direct line, which is just 0459 934 889, or you can call our main line as well, and one of our great client services team will be able to help you out with any questions that you may have. So yeah, just following on that, of course, you can see there that Diamond membership exclusive for our webinar viewers here today. A lot of great feedback that we've been getting over the last couple of weeks, so we really appreciate that. Any questions, any feedback, please feel free to pass that on to us. So hopefully we can continue creating more great content going further. So thank you so much everyone for watching. Hope you got some value out of that as well. As I said, any questions, please send them through and one of our great team will be happy to help you out. Real quick one today, relatively quicker one today, and hopefully we'll be able to see you in the coming webinars next week. Thank you very much, everyone.